Troy Sharpe here, CEO of Oak Harvest Financial Group, along with Chris Perras, Chief Investment Officer. We're here to talk to you today about what we expect to see happen in the fourth quarter of 2020, now that we are post-election, and also what we expect to occur in 2021. Now, there's always uncertainty out there, and of course, the forecast that we talk about today is what we see, it's what we believe will happen, but of course, there's always uncertainty out there. There's risk investing in the markets. By the time there's no uncertainty, the markets are at all-time highs, and then that's when a lot of people who've sat on the sidelines forever, they feel comfortable getting in, and at that time it's too late. The markets have made all their gains, and that's why a lot of retail investors tend to lose a lot of money, because by the time it's safe, it's really not safe.
Or they miss out on the opportunity. The easy money, as they always say on TV, has been made because the easy money, it's never easy in the stock market. Unless it's someone else or you inherited it. The easy money is made when others are frightened and times are uncertain, and you invest and you have patience and time on your side.
So to provide a framework here, when we talk about investing money in the market, those of you who know us, who are clients of Oak Harvest Financial Group, you understand we're talking about investing, but within the context of a plan. We should never put more money in the market, especially when we're in retirement or approaching retirement, that we can emotionally withstand to see fluctuate, because short term anything can happen in the market. Going back to the coronavirus market updates that we released in March and April, we talked about this being an event-driven recession, not a structural recession, so the market should rebound much more quickly than the economy. We expected the markets to take somewhere between 4 to 8 months to reach back to their all-time highs. And then the second half outlook. We talked about the 4 S's, the science, the stimulus, the seasonality, and the consumer sentiment. The science, we always believed that we would have a vaccine by the end of the year. We always felt that the stimulus, the backdrop that Congress and the Federal Reserve that they were providing to the marketplace created a very bullish scenario for stocks, and that's why we felt the market would reach all-time highs sometime before the end of the year. So here we are now, post-election. A lot of the fears that people had leading up to the election, what happens if Joe Biden wins? What happens to taxes? What happens to a burdensome regulatory environment? Should I go to cash? Should I get completely out of the market? And of course, we've been telling you no, that we need to stay invested, of course, within the context of a plan. But just for a minute, why should people stay invested with the fear of high taxes possibly and a more regulatory burdensome environment on the horizon? Why were we recommending people stay invested?
Yep. So we did a couple podcasts way back in June and July in advance of the election, laying out the reasons. If you look back historically, who is running the country at the very top level doesn't matter as much as the policies overall of the Federal Reserve backstopping the market and providing monetary stimulus. And then whoever gets elected tends to get one thing. They get one decision to make over the next couple of years. And so long as the policy isn't out of left field, most corporations in America, in the stock market, can actually adapt to that change. If it's higher taxes, in the past, they've proven to accelerate capital expenditures, which creates some higher depreciation, but it accelerates the economy, and that combats the tax effect there. So, trying to game every policy in Washington, D.C. is an impossible task. So staying the course, over time, it hasn't mattered from a number standpoint dramatically if it's a Republican or a Democrat. The best scenario is when there's a little conflict in Washington, D.C. and policies can't lurch all the way to the left or all the way to the right.
And this is the Goldilocks scenario, which we're going to talk about a little bit here for looking forward to the fourth quarter of 2020 and also into 2021. So we've had trillions and trillions of dollars of stimulus go into the marketplace, both from the Federal Reserve and from Congress. We've said all along that we felt the fourth quarter of 2021, regardless of who won the presidency, was going to be a good quarter for the markets, and 2021 was going to be a really, really good year for the stock market. So here we are, post-election. It looks like Joe Biden probably will win the presidency. Looks like Republicans will win the Senate. and the Democrats, of course, kept the House. So let's just put the politics to the side for a second and talk about the Federal Reserve. What is it that the Federal Reserve is going to do from now until the next 18 to 24 months, most likely?
So the Federal Reserve, they set short-term interest rates. And with their quantitative easing policies, QE 1, 2, 3, they help kind of move the long-term interest rate picture around. September 16th, just a couple months ago, they announced what I have called QE5. They said they're going to buy $120 billion per month of Treasury securities, mortgage securities, in an effort to help stabilize the Treasury markets and the credit markets and to stimulate the economy in a monetary fashion.
So what this means is they buy the Treasury bonds, those funds go into the bank, those bonds go on the Federal Reserve's balance sheet. By buying those bonds, drives the price up and the interest rates down, and the banks have that money and it can flow through the system. So we've seen since the Obama administration coming out of the 2008 crisis, the Federal Reserve implement this exact policy. And for about every $400 billion that the Federal Reserve injects into the financial system, the S&P goes up about 200 points. So if we're looking at $120 billion a month for the next 12, 24 months or so, we're looking at one of the most likely scenarios is the beginning of a bull market.
Yes. Yeah. If you look back at fourth quarter 2012, when QE3 was launched during the second Obama presidency, the stock market had a bull run for 15 months. If you look at what President Trump did with the tax cut plan in the fourth quarter 2016 through 2017, bull market for about 15 months.
So this is a great point here. So 2012, Obama gets reelected. We have a divided Congress, and the Federal Reserve is pumping money into the system through the quantitative easing programs. The S&P in 2013 earned over 30% returns. So now we're not saying we're going to make 30% next year, but I would not be shocked at all if the market earns somewhere between 20 to 30% over the next 12 months. Okay, so we know what the Federal Reserve is doing. What about Congress? The political football, so to speak, of another stimulus bill from Congress being thrown back and forth. Now that we're post-election, probably going to get done to some extent. So another $1 trillion or $2 trillion, somewhere in that range, probably going to be injected into the economy?
I guess it's a guess, 1.5, sure. They seem to be going in that direction before the election, and then politics got in the way, and they decided that neither party wanted to get anything done before the election because they didn't want to give the other party a win. So politics got in the way of helping consumers and helping the economy. With the elections out of the way, fingers crossed on that, over the next 6 weeks to 2 months, come first quarter of 2021, it is most likely the number one goal of the people in Washington, D.C.
So we have Congress injecting money into the system. We have the Federal Reserve, about $120 billion a month for the foreseeable future, injecting money into the system. But retail and institutional traders have trillions of dollars on the sidelines as well. Yep. You expect that money to flow into the market?
Expect some of it. If you look at the retail money flows over the last, say, 8 years net, baby boomers have been selling stocks, particularly when stocks are going down, and millennials have been buying them. Over the last 6 or 9 months, with the volatility levels as high as they've been, hedge funds have been largely on the sidelines. As volatility comes down, as policies are a little more set in stone in 2021, what happens is those hedge funds start moving their chips back onto the table.
So, long story short here is we will have trillions of dollars flow into the economy, flow into the marketplace over the next 12 to 24 months. And this is going to be an unprecedented amount of dollars flowing into the system. So in our opinion, the stock market is very likely to have a really good year over the next 12 months. But to top that all off, again, we have this Goldilocks scenario, it looks like, where we have gridlock in Congress, which means from a public policy standpoint, it's not going to lurch too far to the left, it's not going to lurch too far to the right. It's just right there in the middle, that Goldilocks scenario. And again, we saw this in 2013 after Obama's reelection. And just another positive sign for what to expect over the next 12 to 24 months.
Yeah, the untold story, I think, of the elections is that the House of Representatives, which virtually everyone in the financial press thought was going to move more Democratic by 10 to 15 seats, is moving in the other direction, and I think the Republicans are going to pick up between 8 and 10 seats. And I read an article today saying if that's the ultimate outcome, that the margin that the Democrats hold as far as a majority in the House of Representatives will be the smallest it's been in like 60 or 70 years. The nation isn't jumping far left. The nation is relatively, middle stream, conservative, and this election proved it, right? We have a couple cities out there that, as we all know, are much more left of center, but demographically, heck, you even look here in Texas down in the border when everyone thought that it was going to go jump to Democrat, and along the border it went largely to the President Trump.
So a lot of reasons why we feel the market will continue to increase, just as we stated back in our second half outlook, which is on our website. You can check that out. But one more thing I want to talk about is the stock market follows corporate earnings. The stock market only really cares about a couple of things. Of course, the Federal Reserve and everything that we've talked about, but they care about, are corporations in America making money, and at what rate are those profits growing? This helps to determine what a stock's individual price is, which ultimately helps to determine what the level of the stock market is. So when we look at earnings in 2020 versus earnings in 2021, obviously we expect to see a pretty big increase in corporate earnings, which again should add fuel to the fire of the stock market going up next year, correct?
Correct. My personal belief is the only question is going to be throughout most of 2021, if you are going to make marginal changes within a portfolio, where do you make them? Where do you make them from a sector perspective, and where do you make them from a market cap perspective? Because as the economy starts to accelerate, say the vaccine is out there in the first quarter and millennials are out back at restaurants and gyms and spending on variable things as opposed to buying a new house or buying a new car, they're spending on these smaller items. Do you want to be in small cap companies, or do you want to be in value companies more than you want to be in large cap growth? Large cap growth has led us for the last 10 years. It's really led us out of this recession. But we've seen it the last 4 months. There's been periods where small cap and value stocks have lurched forward at a faster rate. And that's because big institutions that have all this money are trying to move it around with the anticipation in advance of the economy picking up next year. And by the time it's all clear to everyone, normally what happens is these small companies, these value companies are already up 30, 50%. And people's asking why.
Because those are the companies that are really out of favor during economic lockdowns, and when the economy is not doing well, those sell off hard. They really get depressed in prices. So there's opportunity there when no one else wants them. A lot of times that's, of course, when you want to be investing in those. But they don't come without risk. We've also seen over the past couple of years this head fake where value and small cap looks like it's going to outperform, and then sure enough, what happens? Large cap growth just takes the lead and leads the stock market higher and higher. So, but one other thing that we're seeing with respect to the beginnings of a possible bull market, which we do believe we're on the precipice of, is that tug and war between value and growth, small cap and large cap. This is indicative of the beginnings of a bull market.
Yes. Yeah, what happens is instead of just a few names working, and people, on TV, they talk about FANG, Facebook, Amazon, Microsoft, Google, and a lot of other smaller, very fast growing companies, instead of just that group working, the market broadens out. So financials work, and construction companies work, and construction equipment companies work. Because big institutions look forward into their earnings model and see that $1 in revenue next year to a Caterpillar or John Deere is going to move the needle more than $1 of revenue incrementally to a Microsoft. And so they start front running an improvement in those businesses.
So, long story short here, we expect a strong fourth quarter in 2021, which we talked about in our second half outlook, and of course, even on our first half outlook, I believe. So strong fourth quarter 2020, strong 2021 because of all the reasons we talked about in this video. And what we have to keep in mind is this is one part of a retirement plan. This is the investment side. So the Retirement 360 process is investments, generating income, reducing taxes, a healthcare plan, and estate plan. There is a tremendous opportunity to save taxes right now with a tax plan. And if you haven't done anything with tax planning inside your portfolio, if you're working with someone who's not helping you to reduce taxes over the course of your retirement, let this election be a warning shot across the bow to get it in gear. We need to start taking action. If this would have went, and we don't know for sure, but it looks like the Senate will maintain Republican control. If this would have went the other way, and we would have had that blue wave that the pollsters and everyone was predicting, you would have lost a tremendous opportunity to get the government out of your retirement account, your 401k, your IRA, which is infested with taxes. We need a plan. You need to get that going. So if you're not acting now after this close call, which still it isn't certain, but if you're not acting now, you need to get on it because there is an equal opportunity to make as much money in retirement from reducing taxes for many of you as there is in making good investment decisions. So if you go down below the video here in the description box, there will be a link if you want to set up a phone consultation, or if you're in Houston, you want to come in, sit down, have a cup of coffee, talk about what we've discussed in this video, talk about a plan to reduce taxes in your retirement. Click on that link, reach out to us, and we can get something scheduled. So investments, one part of a comprehensive retirement plan, generating income, generating tax reduction strategies, just as important to have a well-rounded comprehensive retirement plan, which gives your family more security and helps you sleep better at night. Troy Sharpe here, CEO, Chris Perras, Chief Investment Officer of Oak Harvest Financial Group. We look forward to seeing you in the next video.